Good afternoon and welcome to the Deep Dive. Thank you for joining us. We're diving into, well, a really consequential market day, Tuesday, November 4th, 2025. This wasn't just, a day where stocks went down. It felt like more, like a reckoning. It was the moment, the whole consensus, the belief system really, supporting that huge AI-fueled rally. It just seemed to fracture. And the market, it violently rejected what, on paper, looked like genuinely good news.
That's exactly the frame, isn't it? You have to understand this. November 4th wasn't just some technical dip. It feels like it fundamentally shifted market psychology. Everyone suddenly got defensive. So what we're analyzing today is this complex collision of forces. You've got a broad tech sell-off, right?
Technology led the way down.
Yeah, and at the same time, a huge crash in speculative stuff like crypto. And then there's this unique, really unnerving uncertainty from the U.S. government's statistical blackout.
Okay, so our mission today, for you listening, is to figure out just how quickly that tide turned and what exactly broke the market's bullish spell, because it felt like it snapped. We need to unpack, I think, three key things. First, this sell the news idea that just took hold, like even perfection wasn't good enough anymore. Second, those really explicit warnings coming straight from the top, from C-suites at the big banks. And third, this is critical, why suddenly private sector data, which, let's be honest, usually plays second fiddle, why it's suddenly the most important gauge of the U.S. economy.
Well, what's really striking is the sheer speed, the velocity of the bearish asymmetry that day. Think about it like this. Getting a 1% gain lately. You need something amazing, totally unexpected news. But to lose 1%, all you needed yesterday was just a hint of disappointment. Or maybe just someone validating that valuation fear. Any positive news, like you said, it was immediately contained, treated like, oh, that's just company-specific noise. But the negative stuff, especially that fear about peak AI valuation, instant contagion, spread like wildfire. The focus, it's decisively shifted away from just blind hope about growth and landed hard on, well, the cold reality of valuations.
Okay, let's start by just laying out the scale of it, the magnitude, but maybe more importantly, where the selling was concentrated. Because if you look at the headline numbers, yeah, the pain was broad, but the difference between the indexes, it tells a story.
It really does, undeniably. The epicenter, the ground zero for this AI valuation, unwind as we're calling it, that was the NASDAQ composite. Tech heavy. It plunged a steep 2.0%. That's a big move. And it reflects heavy, aggressive selling, institutional money getting out of software, semis, the names that carried the market all year.
And then you contrast that with the other big indexes, the S&P 500, the SPX. It finished down 1.2%. If you look at the CFD, the US 500, that closed at 6,806 points. Still a big drop, obviously, but not quite as bad as pure tech.
Right. But the real story, maybe, of relative stability, or perhaps the lack of outright systemic panic, was the Dow Jones Industrial Average, the DJI. Yeah. The Dow, it's often seen as the old economy index. Industrials, blue chips, less tied to those high-growth stories. It showed relative strength. Now, that's significant. But it still closed down 0.5%. It was down about 326 points mid-afternoon. Trim that a bit at the close.
That divergence, that gap between the NASDAQ and the Dow, that's a really crucial sign, isn't it? Suggests the smart money wasn't panicking about, say, the whole industrial economy collapsing or the consumer suddenly disappearing. It looked like they were specifically, almost surgically, de-risking the future growth priced into those high multiple tech stocks.
Exactly. When the NASDAQ's down 2% and the Dow's only down 0.5%, that screams bifurcated market. It implies the selling pressure was just laser-focused on those mega-cap growth names that dominate the NASDAQ. Because look, if the selling was truly systemic, right? If investors genuinely feared an immediate deep recession was hitting now,
then the Dow would have gotten hammered too.
the Dow, representing all that cyclical industrial exposure, it would have fallen much, much harder. The fact that it held up relatively well suggests this was more about unwinding speculation, maybe froth, rather than panic about fundamental economic collapse.
And this sentiment, this fear, it wasn't just a U.S. thing. It spilled over pretty quickly into international markets.
Yeah.
Suggests that this worry about AI valuations, it's a global conversation now.
Oh, absolutely. Global equity markets, they traded with this decidedly cautious negative bias, both leading into the U.S. Open and then reacting to the drop. Asia, trading during our Monday night, fell sharply, kind of anticipating the trouble. Japan's Nikkei 225, down a significant 1.74%. Hong Kong's Hang Seng also dropped 0.71%. This wasn't some local issue in Tokyo. It felt like fear transmitted directly from Wall Street.
And Europe, same story.
Europe opened lower as well. You had investors there. They'd seen some decent gains recently. They were pretty eager to just book profits, lock things in before the full force of the U.S. negativity hit their markets. It really highlights how interconnected these high-growth valuations are. When the biggest U.S. tech names get questioned,
Everything else follows.
yeah, every correlated global asset, London tech stocks, emerging market funds, they all take a hit. It felt like a synchronized global move to just dial down risk.
Okay, let's dig into the core trigger. The thing that really set off this whole bearish cascade. It came from an earnings report, weirdly enough, but it's a total paradox. We have to talk about Palantir Technologies, PLTR. And this was a name that was basically the poster child for the 2025 AI rally.
And look, Palantir delivered what you'd call a textbook beat and raise. I mean, the kind of report that usually sends a growth stock soaring 5–10% easily. They reported record quarterly revenue, $1.18 billion. That crushed the $1.09 billion estimate. Crushed it. That's a stunning 63% year-over-year jump. Adjusted EPS, well ahead of the $1.17 consensus.
Okay, wait. So, massive revenue beat, $90 million. Solid EPS beat, 4 cents. And they raised guidance, third time in a row.
Yep. And they explicitly cited massive accelerating demand for their AI platform, AIP. Couldn't have been clearer.
So the market reaction to this financial perfection.
The stock plunged immediately, 8–10% right after the release. This wasn't like a mixed reaction. It was an unequivocal, violent rejection of spectacular news. And that right there established the Palantir precedent. The idea that even flawless performance isn't enough anymore to justify these AI valuations.
Why does that happen? We hear priced for perfection all the time, but what does that actually mean for someone listening, like in practical terms?
Okay, so it means when a stock like Palantir has already rocketed up over 174% year-to-date, which it had, the market isn't just expecting a great quarter. It's already baked in perfection for like the next year or more, 3–5 quarters out. So when that perfect report finally lands, the big institutions, the algorithms, they don't see it as a reason to buy more.
They see it as a reason to sell.
Exactly. They realize, okay, where's the next catalyst for another 100% gain? There isn't one immediately obvious. So it becomes the perfect exit point, the ultimate liquidity event. Time to lock in those massive profits, maybe driven by tax reasons too. That profit-taking creates selling pressure. And because the stock was so popular with momentum funds, the selling just feeds on itself. Downward momentum takes over.
So the Palantir precedent wasn't really about Palantir's business being bad. It was a signal about the market's mood towards all expensive AI stocks. It validated the fear that valuations were just too stretched.
Absolutely. Spot on. And that mood, that psychology, it was actively encouraged by the second T driver we mentioned, that authoritative bearish narrative coming straight from the top of Wall Street.
Right, this wasn't just nervous retail traders. This was the big institutions saying, be careful, very publicly. We saw CEOs, top execs from places like Morgan Stanley, Goldman Sachs. They were out there warning investors, talking about a potential material pullback, a significant correction, more than 10% maybe in the next year or two. And they explicitly said why. Frothy valuations, particularly in tech.
That kind of talk, it provides the intellectual cover, if you will, for the profit-taking we saw in Palantir and right across the NASDAQ. You had a strategist from JP Morgan, for instance, on the record saying it was healthy to see some of the steam coming out of more speculative parts of the market. When the big banks basically give investors permission to take risk off the table, the sell-off just accelerates. It shifts the whole mood. From FOMO, fear of missing out, to maybe FOBS, fear of being stuck.
And what about the structure of the market itself, this idea that only a few stocks were doing all the heavy lifting?
Yeah, that's where that Schwab analysis comes in, talking about narrow breadth. And that is a classic massive red flag. Narrow breadth means the whole index, like the S&P 500. It's being dragged higher by just a handful of mega cap winners. You know, the Magnificent Seven, plus a few other key AI infrastructure players. Imagine, like, a tug of war. One team has 7 giants. The other team has, like, 493 regular-sized people. As long as those 7 giants pull, the rope moves forward.
The second those giants stumble,
the whole thing collapses. Exactly. The vast majority of stocks within the S&P 500 might have been flat or even down for the year, hidden under the surface by the performance of those few big names. Historically, analysts always point out, when a rally is that narrow, that concentrated, it usually hasn't led to the best outcomes.
Why is that?
Because when those few massive stocks finally face their own valuation crisis, like the one maybe triggered by Palantir, there's just nowhere else for that big money to rotate into for support. The broad market doesn't have the underlying strength, the breath to absorb that kind of shock. So you put it all together. The tangible earnings rejection of Palantir, the explicit C-suite warnings, it created this powerful self-fulfilling feedback loop that just sped up the selling.
Now, to really get the gravity of Tuesday's action, we have to layer in this extreme macro instability. This tech wreck didn't happen in a vacuum. It happened with the U.S. government shutdown hitting, what, day 35, tying the record?
35 days ties the record. And this is way more than just political drama. It creates a structural information vacuum. We're calling it the statistical blackout. Key agencies, Bureau of Labor Statistics, Census Bureau, they've suspended operations. They're not collecting data, not releasing reports.
And the direct impact for investors, for you listening, is that critical reports we rely on, they're just delayed indefinitely. Reports on inflation, spending, and crucially right now, the labor market.
Precisely. We specifically lost the JOLTS job openings report. That was actually due on November 4th, the day of the crash. JOLTS gives us that key insight into labor demand, quit rates, hiring, the tightness of the market. But even more critical, the big one, the official non-farm payrolls report, the NFP, originally due November 7th, indefinitely delayed.
The NFP is the gold standard, right? It's the one everyone waits for. What happens when the Fed, the market, suddenly don't have their most trusted, most comprehensive data point?
Well, the market is suddenly flying blind. That's the phrase. NFP isn't just one number. It's this incredibly detailed report. It has revisions to past months, demographic breakdowns, wage data, labor force participation, stuff that gives you context. Without NFP, the whole structure of economic forecasting, it kind of starts to wobble. Even Fed Chair Jerome Powell admitted it's tough making policy decisions in this kind of fog when your main indicators are just missing. Uncertainty breeds inaction, or worse, policy mistakes.
Okay, so when the official gold standard data just vanishes, what does the market do? Where does all that intense focus shift?
It triggers this massive, immediate macro proxy shift. This is really the key concept for you to grasp right now. All that institutional focus, all those algorithms, they immediately pivot to the only available private sector proxies. And their importance just gets amplified exponentially. Look, traders can't just stop trading. Algorithms can't stop running models. But those models are now being fed dramatically less reliable, less comprehensive data.
What are these proxies specifically? What is the market actually looking at now instead of JOLTS and NFP?
Well, the main labor market proxy becomes the ADP National Employment Report, which we'll get into for Wednesday. That's the big one. But beyond that, traders are digging into this patchwork of, frankly, less common sources. They're looking at data from private staffing agencies, corporate surveys like the ISM reports, credit card data, tracking spending velocity, even things like payroll processing data from companies like ADP itself, or paychecks, information that's less regulated, much narrower in scope, and it just doesn't have the rigor or the depth of the official BLS data.
So the stakes for Wednesday's private reports are just astronomical now. They're not just previews anymore.
That is the absolute key takeaway. Wednesday's ADP employment report and the ISM services PMI. They are no longer just helpful previews that analysts use to tweak their NFP guesses. They are now the primary market-moving data points. They are the only real-time gauge we have for the U.S. labor market and the huge services economy. Any deviation from consensus in these private reports, it's going to cause an outsized market reaction simply because there's no official data coming later to confirm, deny, or provide context. This blackout has seriously cranked up the volatility and the risk.
The intensity of this sell-off, it really confirms the fear wasn't just stuck in tech valuations. It was a full-blown flight to safety, a pervasive risk-off signal that just swept across pretty much every major asset class. Let's look at that cross-asset dashboard.
You see the fear instantly in fixed income, in bonds. Investors, they're panicking about the equity volatility, maybe recession fears amplified by that data blackout. They rush into safe-haven U.S. Treasury assets. Demand for bonds goes up, yields fall. The benchmark 10-year Treasury yield eased quite a bit, fell to 4.09%. The sensitive 2-year yield softened to 3.58%. That signals money actively moving out of risk into perceived safety.
And those concerns about global demand, global growth, you can see that in commodities, too.
Oh, yeah, absolutely. WTI crude oil futures fell, what was it, about 1.7%? Settled around $60.40 a barrel. That's a direct read-through on expected economic slowdown. Lower oil prices mean traders expect less industrial activity, less travel, less future demand for energy. Even gold futures, often seen as a haven, actually declined 1.6% to $3,950 an ounce. That specific gold move, it's often tied to what the dollar is doing.
Which brings us to currencies. The U.S. dollar index, the DXY, it rose 0.4% to 100.23.
Right. The dollar, it's the world's ultimate reserve currency. It acts as the universal safe haven in moments of extreme volatility or uncertainty. When global risk flares up like this, investors, both here and abroad, they flock to cash and the perceived safety of the dollar. That drives its value up against other currencies and sometimes against commodities like gold, too. So a stronger DXY just reinforces that risk-averse environment.
But look, if you want the clearest, maybe the most visceral sign of risk appetite just evaporating, you look at the speculative canary in the coal mine,
Right.
the crypto crash. This wasn't just tech stocks having a bad day. This was a mass liquidation event in digital assets, and it happened before the equity fear really took hold.
It was severe. Bitcoin, BTC, plunged over 6% in a really short period, broke below that huge $100,000 psychological level for the first time since June, closed around $100,282. Ethereum, ETH fell even harder, down 9, maybe 10%. This was the market's highest beta segment, just reacting violently to the sudden realization that maybe liquidity was shrinking and those valuation fears were back with a vengeance.
You called it a mass deleveraging event. For listeners, what does that actually mean? What's happening there?
Okay, it's basically a domino effect driven by margin borrowing. Lots of traders in crypto use high leverage. They borrow money to make bigger bets. When the price of Bitcoin, or whatever they're trading, starts dropping fast, these leveraged traders get margin calls. The broker demands more cash, more collateral to cover potential losses. If they can't meet that call, like instantly, the broker doesn't wait. They automatically liquidate the position, force sell.
And that forced selling pushes the price down even more, triggering the next round of margin calls.
Exactly. You get this cascading liquidation loop. We saw reports of over 1.3 billion with a B in leveraged long positions liquidated across crypto exchanges in just that short time frame. That kind of forced systemic selling pressure. That's what turns a correction into a crash. And what's really telling is we saw clear signs of institutional retreat before the equity market cracked. On November 3rd, the day before, U.S. spot Bitcoin ETF saw significant outflows, $186.5 million out. Spot Ethereum ETFs, $135.76 million out. It felt like the institutional fast money saw the writing on the wall in crypto first and proactively started pulling back from all speculative bets.
So the regular session closes, broad pain everywhere. Then the drama shifts to after-hours trading, and it delivered this really complex, almost split report card. We saw some genuinely strong results, actually, but they were completely overshadowed by one catastrophic miss, a miss that seemed to confirm every single fear the market had about AI valuations.
Yeah, the Supermicro Computer Report, SMCI.
Wow.
That was the defining event after the close, no question. SMCI, you have to understand, they're not software. They are a direct proxy for AI infrastructure spending. They build the server racks, the cooling, the hardware that physically powers this whole AI revolution, often for huge customers like NVIDIA. Their results, they provided concrete, verifiable validation for the day's whole bearish story.
Let's dive into that blow-up. Okay, they managed to slight EPS beat, right? Instead of 31 cents versus their 18.28-cent consensus. That's fine. But the revenue, the top line was the disaster.
Catastrophic is the right word. Revenue came in at $4.6 billion. The consensus estimate was an aggressive $5.5 billion. They missed by nearly $1 billion. When you miss your revenue target by almost 20%, in the sector that's supposed to be exploding, alarms just go off everywhere. But the critical blow, the thing that's going to stick with the market for weeks, was the guidance cut.
Okay, talk us through that guidance change. What do they say about the future?
They slashed their full year 2025 revenue guidance significantly. They had previously expected somewhere between $23.5 billion and $25.0 billion, the new range. $21.8 billion to $22.6 billion. That is a massive downgrade in what they expect to sell going forward. It signals either substantial project delays, maybe increased competition, or, and this is what worries the market most, maybe a slowdown in how fast customers are actually spending on AI infrastructure. The stock immediately collapsed, 5.56% after hours, and it dragged down other related names with it.
Why does an SMCI miss matter so much more than, say, some random software company missing its numbers?
Because it's tangible, it's physical. Palantir gave us the psychological precedent. Okay, perfection isn't enough. SMCI gave us the physical evidence. Evidence that this massive, accelerating AI infrastructure investment thesis, maybe it's hitting a snag. It's the first concrete sign that the spending boom might be slowing. Or maybe just that analyst expectations got completely disconnected from the reality of supply chains, deployment schedules, hyperscaler budgets. This report felt like a reality check, delivered in, server racks and balance sheets. It provided tangible proof for all those frothy valuation concerns we talked about.
And SMCI wasn't the only one confirming that news sell the news paradigm after hours. Arista Networks, ANET, They focus on the high-speed networking for AI data centers. They had strong results, and the market still punished them.
Yeah, Inet delivered excellent numbers, actually. Beat revenue expectations $2.308 billion versus $2.26 billion consensus. They even gave strong Q4 guidance, a range of $2.3 billion to $2.4 billion. Solid. And yet the stock still fell 2.41% after hours. That's the Palantir precedent, confirmed and replicated right there in the hardware space. Even strong, positive future performance in core AI infrastructure plays met with profit-taking, not buying. The market is rewarding defense, not strength.
The nervousness got so intense that traders didn't even seem to wait for the results from the next big semiconductor player, AMD.
Right. Advanced Micro Devices, AMD, they were scheduled to report later after the bell, and the stock was already down 2.59% in after-hours trading before its results were even public. That tells you everything, doesn't it, about the negative read-through from SMCI. Investors were just pricing in disappointment immediately. They knew AMD's high expectations, especially around data center revenue and their new MI350 GPUs, would be under intense scrutiny. And likely wouldn't be enough to justify the stock's, 115% year-to-date rally. The bar was just too high.
Now, it is crucial to point out, amidst all this AI valuation carnage, there were a few positive outliers. Stories of genuine, fundamental success. But the market largely just contained them, ignored them, which kind of highlights the overall risk-off mood.
Yeah, the most significant success story, maybe surprisingly, came from the EV sector, a segment that's really struggled with profitability. Rivian's Q3 report after the close. Unequivocally strong for a growth company like them, they beat revenue expectations, posted $1.558 billion versus the $1.51 billion consensus. Good start.
But the really crucial metric for Rivian was profitability, right? That's been the big question mark.
Absolutely. The milestone that truly mattered for their long-term viability, the thing everyone was watching, they achieved $24 million in consolidated gross profit. For an EV startup, getting to positive gross profit, that is a massive hurdle. It signals they're not losing money on every single vehicle they sell anymore. It suggests they've started to successfully scale manufacturing efficiency. That's a powerful, optimistic counter-narrative, even if the broader market basically shrugged it off that day.
We also saw a bit of a flight to quality into healthcare, which is often seen as defensive when things get choppy.
Right. Amgen, the biotech giant, delivered a comprehensive beat, both top and bottom line. $9.6 billion in revenue. That crushed the $8.94 billion consensus. EPS of $5.64 versus $5 expected. Really strong. And the strength was broad-based, driven by 14% volume growth across 16 different products, both mature and emerging. The stock traded higher, up almost 1%, 0.94% after hours, kind of acting as a haven amidst the tech storm. It confirms investors are willing to pay up for proven, reliable, non-cyclical strength right now.
But let's be clear, those were isolated pockets of good news. Away from Rivian and Amgen, the regular session saw some really significant carnage in specific stocks, reinforced that broad, generalized risk aversion.
Oh yeah, we saw some brutal sell-offs tied to specific company news. Look at consumer discretionary, look at biotech failures. Norwegian Cruise Line, NCLH, plunged 15% after disappointing earnings, and that immediately dragged down rivals Carnival, CCO, and Royal Caribbean, RCO, down 9% and 7% respectively. Signals real consumer caution maybe on big-ticket travel. Sarepta Therapeutics, SRPT, a biotech name totally dependent on clinical success, nosedived 33%, failed clinical studies, devastating. Even a huge name like Tesla sank 5%. That followed news that Norway's massive sovereign wealth fund rejected the proposed $1 trillion CEO pay package, puts a spotlight back on governance, accountability.
And just for proof that weird, idiosyncratic news can still move a stock against the tide, what was the most bizarre gainer of the day?
That had to be Denny's, DENN. The diner chain skyrocketed 50%. News came out it was being acquired for $620 million in cash. That transaction had absolutely nothing to do with AI or interest rates or the blackout, just pure isolated M&A news defying the overall negativity. Shows the market isn't completely broken, I guess.
Okay, so the futures market basically confirmed overnight that Wednesday, November 5th was going to be a lower open. No surprise there. The SMCI miss completely dominated the positive vibes from Rivian or Amgen. U.S. stock futures pointed sharply lower. Even the S&P 500 futures down close to 1.1%. NASDAQ 100 futures down maybe 1.3%, 1.4%. Rough setup.
Which means Wednesday is now this critical inflection point, not primarily because of the next batch of earnings, actually, but because of those two macro reports whose importance has just been exponentially amplified by that statistical blackout we keep talking about.
Right. Let's start with the ADP National Employment Report. That's due 8:15 a.m. Eastern Time. We know the context here is pretty desperate after a really concerning reading last month.
Yeah, we really can't overstate how fragile the labor market context feels right now. This report follows that dismal September reading, which showed a net loss of 32,000 jobs in the private sector. That was the first time, outside of the initial 2020 COVID shock, that the private sector cut jobs for 2 months running. That data point really heightened recession fears dramatically.
So what's the consensus actually expecting for this October report? Any kind of rebound?
Well, the consensus forecast is extremely muted. They're expecting only a very tentative rebound. Estimates are ranging only between like plus 22,000 and plus 31,000 new private sector jobs. Tiny numbers. The market is already braced for a significant slowdown.
Okay, so what's the implication if ADP misses even that incredibly low forecast? What if we get a second negative print?
Look, a miss to the downside, say, private job growth comes in below 20,000, or worse, a second consecutive negative print. That would be devastating. It would signal not just a stalled labor market, but potentially one that's actively collapsing. That scenario, it dramatically escalates recession fears, it likely triggers powerful selling in equities, and it might even force the Federal Reserve to immediately pivot its language towards potential emergency easing measures. Conversely, a strong beat, say over 50,000 jobs, that might be the only thing capable of taking some pressure off after the tech wreck.
Okay, then later, 10:00 a.m. Eastern, we get the ISM Services PMI. You stressed earlier, this is arguably the single most critical macro report of the week, even more than ADP right now. Why does the services sector hold so much weight?
Because the vast services sector, it represents roughly 70% of the entire U.S. economy. It's the last pillar holding the whole structure up. It just is. We know manufacturing is already contracting. The ISM manufacturing PMI already worsened at 48.7. Remember, anything below 50 signals contraction. The services report for September was exactly 50.0, right on that razor-thin dividing line between expansion and contraction. We are literally standing on the edge.
And the consensus forecast for the October services PMI number, are they expecting it to hold?
Just barely. They're forecasting a tentative little uptick to a reading somewhere between 50.5 and 51.0. The market is basically just hoping the services sector maintains some slight positive momentum. The stakes for this number are immense.
Let's talk about the downside scenario here, because the market is clearly pricing in risk. What happens if ISM services slips below 50?
If that ISM services number comes in below 50.0, that is the defining data point of the day, possibly the defining data point of the month. It signals that the huge engine of the U.S. services economy has officially joined manufacturing in contraction. At that point, a broad-based recession isn't just probable anymore. It becomes the base case assumption for most analysts. That scenario would almost certainly accelerate the equity sell-off, and it would likely ramp up bets on aggressive Fed rate cuts later this year, cuts driven by systemic economic failure, not just because tech stocks got too expensive. The ISM Services PMI, that is the line in the sand this week.
So given this intense skepticism after the Palantir reaction and that devastating SMCI confirmation, the burden of proof for Wednesday's earnings slate is just extraordinarily high. Companies basically have to deliver flawless results and stellar forward guidance, or they're going to get punished.
Yeah. The aftermarket focus on Wednesday will be squarely on the next major test for that AI and semiconductor narrative. Specifically, how does the SMCI revenue shock ripple through the rest of the supply chain? We're looking at two major reports after the close: Qualcomm, QCOM, and ARM Holdings, ARM.
Okay, what specifically are investors demanding from these reports to avoid that Palantir fate, that sell the news reaction?
Well, for Qualcomm, the market's intensely focused on their transition, moving away from just relying on 5G mobile phone chips and more into AI on-device processing, automotive chips, those growth areas. Analysts need to see concrete data points on design wins. They need clear visibility into next year's high-margin revenue streams, a strong beat on their IoT segment, Internet of Things, which includes a lot of smart device AI applications. That's essential. Any perceived softness in their forward guidance will be read directly through that SMCI lens. If the hardware guys are struggling, is the demand already peaking?
And for ARM Holdings,
Yeah.
licensed chip designs, right? Different model.
Different model, even more speculative, arguably, given its high valuation since the IPO. For ARM, the focus is entirely on licensing agreements and royalty revenue connected to those next-generation AI processing units. Since ARM's performance is kind of a leading indicator for the whole mobile and edge computing ecosystem, the market will scrutinize any commentary on royalty rates and, crucially, guidance that demonstrates accelerating momentum in their most advanced, highest-margin chip designs. Anything less than a monumental positive surprise probably triggers profit-taking just based on that Palantir model. High bar.
We also had some key reports before the market opens Wednesday that touch on the health of the consumer. which seems essential context given all these recession fears swirling around.
Definitely. We'll be watching McDonald's MCD very closely before the bell. McDonald's often acts as a decent proxy for the lower income, maybe middle income consumer. Any commentary from them on foot traffic, same-store sales growth, maybe any shifts towards their value menu items, that gives us real-time insight into household budget stress. Also, Novo Nordisk, NVO, crucial for insight into sales growth for those huge weight loss drugs, Ozempic, Wegovy, and whether the U.S. market is maybe starting to see any pricing pressure there. These reports, they'll give us valuable early insight into consumer resilience or lack thereof ahead of those delayed official numbers.
So if we had to synthesize this brutal Tuesday,
Uh-huh.
the market posture has just definitively shifted from buy the dip to sell the rally, validating those valuation fears.
Precisely. The dominant narrative now is valuation fear, coupled with that concrete evidence of a potential AI infrastructure slowdown via Supermicro's miss. And this whole bearish turn is happening in a total data vacuum, that statistical blackout which just places immense outsized pressure on tomorrow's ADP and ISM services reports. A highly defensive posture seems warranted right now. The environment is violently punishing sector-specific negatives and basically choosing to ignore company-specific positives. Hashtag outro.
So Tuesday, November 4th, it was defined really by two powerful forces clashing. First, that self-correction within the AI sector itself, driven by Palantir's psychological precedent, and then devastatingly confirmed by Supermicro's financial miss. And second, the vacuum of official economic data that has just magnified tomorrow's private reports into truly make-or-break market-moving events.
Yeah, the environment is just acutely risk-averse right now, demonstrating that classic bearish asymmetry we talked about. Positive outliers ignored, sector negatives extrapolated instantly into contagion, which leads us to really question the very structure of market reliance, doesn't it? Especially in the face of this unprecedented data blackout.
And that leads perfectly into our final provocative thought for you, the listener, to maybe mull over. Since the non-farm payrolls report the most comprehensive, trusted data source we have, since that's delayed indefinitely, and the market, the Fed, everyone is flying blind into these less reliable private ADP and ISM reports, what does it truly mean when the world's most powerful decision maker, the Federal Reserve and all those institutional algorithms, when they are all forced to rely entirely on proxy data to gauge the health of the world's largest economy?
Right. If the Fed is using narrower, potentially misleading data to set monetary policy, doesn't that significantly increase the risk of a policy error? A disastrous move that maybe accelerates a recession or completely misinterprets the severity of the situation simply because the official picture, the full picture, remains entirely dark.
What unseen systemic risks might be accumulating just out of sight, while we all fixate only on what these limited proxy data points permit us to see?
That's the question looming over the markets this week.
We will absolutely be here tomorrow to unpack those critical ADP and ISM results and the market's reaction. Thank you for joining us for this deep dive.